In this session, we're going to look at some financial performance metrics, some performance indicators that we usually see from company balance sheets, like return on equity, and try to relate it back to operations metrics, things that can be achieved directly through operations. So we're going to try and add some specificity to the idea of how operations can relate to return on investments, more specifically return on equity. So let's do a little bit of exercise here, and this exercise is called the DuPont analysis because the DuPont company started looking into such a breakdown of return on equity in order to get more insights into their operations. So what you have as a return on equity is the ratio of earning before interest and taxes divided by the equity. And equity simply means the stockholders' investments, the shareholders' investments in the company. And so what you're looking at is the earning before interest and taxes, the operating income as related to the investments that the stockholders have made in the company. Now, this can be broken down based on the DuPont analysis into three different ratios, three different individual ratios, the first of which is the equity multiplier. The equity multiplier has nothing to do with operations directly, so we're going to keep that aside. It's basically how much of the assets are being financed by the equity. Now, talking about the second and the third ratio, what we have there are ratios that can be impacted by operations: the asset turnover ratio and the operating margin. You put both of those together, and they're called the return on assets. The return on assets, if you were to look at it as a ratio in itself, is your earning before interest and taxes divided by assets. So how much of your how your assets are being utilized in order to make your earnings before interest and taxes, your operating margin, your operating income. So let's break these two things down and look at them individually. Let's take the asset turnover ratio first. So this ratio is telling you how efficient you are as a company in terms of generating sales from your asset base. What does the asset base of a company have? Well, it's got the fixed assets, it's got the equipment, the location, the stores or the factories that the company owns, and it also has the current assets, which are the inventory and the accounts receivable that the company is owed. So those are the things that are going into this ratio, the sales and the assets which are incorporated of fixed assets and current assets. Look at the second ratio that we said is impacted by operations, and you have the operating income or the earning before interest and taxes divided by sales. Now here it's very easy to see what the operations aspect would be impacting, and that obviously would be the operating income. Let's see how specifically operations impacts both of these ratios. So let's start with the asset turnover ratio first, and then go into the operating margin ratio. So first, the asset turnover ratio. We're talking about getting more sales from the same assets or more sales from fewer assets, or the same sales from fewer assets. What this is telling you is that how well you are using your assets in generating your sales. Now, if you think about operations metrics, things that we usually measure in operations, we measure things like equipment uptime, overall equipment effectiveness. How well are we able to use our equipment? How much of the time is it available to be used versus it's down for repairs or has been shut down because there's a setup change and things like that. When we think of operations metrics, we also look at setup time as being time that is being taken away from a machine or equipment being utilized for giving us productive sales. When we think about operations, we can also think about part commonality in terms of what are the different parts that are going into making different types of products, and if we're making many different types of products from common parts, it helps us reduce the inventories that we keep in stock. So it helps us with inventory control. In general, even without part commonality, good inventory control helps keep inventories low, or we should say that it helps us keep the right kinds of inventory for sales. So that's a metric that helps in terms of generating more sales from the same inventory or generating the same amount of sales from less inventory. And as we saw earlier, operating margin is very straightforward in terms of how it would be impacted by operations, because there we are talking about reducing costs, making things at a lower cost, and that would entail, from an operations perspective, not having defects, having higher yields from our operations, from our processes, and that can help us with generating lower costs, generating sales with lower costs, and having a better operating margin. Right, so let's do an example here and work with some numbers in terms of these three ratios. So what you have here is two fictitious companies, and they're called Luxor and Hi-Tech. And what you will need to do in this case is look at these numbers that you're given and compute the three ratios that you just saw in the earlier slides. So you have the return on assets, the asset turnover ratio, and the operating margin. And once you go through the mechanics of doing this, calculating these ratios, what I'd like you to think about just looking at these ratios is what insights do you get from looking at these ratios of these two companies. So let's do the numbers and see what we get. So let's start with the return on assets first. And the return on assets for both of those companies, so let's do Hi-Tech here and Luxor over here. So return on assets is your operating margin, and your operating margin for Hi-Tech is 200,000. And the asset base that we have is 1,650,000. And I'm doing this in thousands, so I'm just writing this down as 200 divided by 1,650. For Luxor, the same things are 60,000 divided by 495,000. Right? The second ratio that we want to look at is the asset turnover ratio. And that is simply your sales divided by assets. So the sales for Hi-Tech are 2 million, and the assets are 1,650,000. For Luxor, the same kinds of numbers are, you have 1 million divided by assets, which is 495,000. Last, let's calculate the operating margin. Which is your operating income for Hi-Tech, that's 200,000, divided by sales of 2 million. And then for Luxor, it is 60,000 divided by sales of 1 million. Now, if you see, you've got the solutions given to us on the next slide. We have the return on assets, the asset turnover, and the operating margin for both of these companies. What do you notice here? You see that the return on assets for both these companies is exactly the same. It's at 12%. So let's reflect on the other two ratios that we calculated for these two companies. The asset turnover. Luxor has an asset turnover of 202%. It's taking its assets and is able to generate quite a large number of sales relative to the amount of assets that it has invested in. The operating margin is higher for Hi-Tech, and it's lower for Luxor. And that's how we got the return on assets for both these companies to be exactly the same. Now, what does this tell us about these two companies? So, if you were to take this purely on a performance basis, Hi-Tech is able to generate sales at very low costs, and that's why it has a higher profit margin. Luxor is not very good with that. It has a 6% margin on its sales. On the other hand, Luxor is able to take its assets, which it's able to turn into sales at a very nice rate. You could take this from a purely performance perspective, but you could also be thinking about this from a point of view of where these companies are in their life cycles, or more precisely, where the assets of these companies are in their life cycles. What I mean by that is the assets for Luxor may be very old and they might be very depreciated, and then you might need to replace these assets in the near future, so that might be something that's coming up. So what we're saying here is that, yes, we can gain some information from these assets, from these ratios that we're looking at, but we should have a a more skeptical look at these ratios and try to find out what's going on. Nevertheless, these ratios help us look at what is happening from an operations perspective and how this company is doing in terms of turning over its assets and in terms of its operating margin. Now let's take a real example of a company, and this company is Anheuser-Busch. So Anheuser-Busch created a big flutter in the year 2008 because it was bought over. Now Anheuser-Busch is the maker of the American iconic beer Budweiser, and it got bought over by a Belgian company, which was the CEO of that Belgian company is originally from Brazil. So it was quite a flutter when that company bought Anheuser-Busch. But look at what the performance of this company after it took over. Now the CEO of InBev, the Belgian company that bought this Anheuser-Busch, is well known for cutting costs and making the companies more profitable. So what he did was he came in and he cut down the cost tremendously. From 2008 to 2009, you see the operating margin has gone from 13% to 16%, and it has since been improving to currently being at 24%. The company's asset turnover, the merged company's asset turnover, was also improved tremendously after the takeover. So they may have cut down their asset base, consolidated their assets, and that gave them an asset turnover ratio of close to 33%, at which it has been maintained since then. So as a result of these two performance ratios getting better, their return on assets went from around 3% to being over 7% in the most recent year. So here you can see how you can get some sense of how operations can help with company performance. Now, the problem with trying to relate operations initiatives with bottom line kind of performance is that there's no direct connection. You can only infer from these types of ratios. Making a direct connection is much harder. First, because companies don't provide their cost accounting numbers. You cannot see their internal numbers. And second, it's also very difficult because most operations initiatives are cross-functional. So it's very hard for you to say that it is this particular initiative that reduced the inventory, or it is this particular initiative that was able to reduce the costs as a result of which we got higher profits. Nevertheless, there's something to be seen from these ratios that we can get from any company's balance sheet.